All right, so today we're going to ditch those stuffy bank suits and explore a world where, your credit score doesn't have to hold you back.
Oh, I like that.
Yeah.
Ditch the suits.
Yeah.
Yeah.
Ever wish there was a secret playbook for financing your business, even if your credit isn't perfect or you need funding super fast?
You know what there is.
Really?
There is.
Tell me more.
It's this awesome guide that we have, and it's called Think Outside the Bank, 10 Innovative Solutions for Financing Small Businesses. And you want to know the best part.
What's that?
It's free.
Free.
Okay, what's the catch? No catch. It's seriously packed with creative ways to get your business off the ground or fuel its growth. And it covers everything from non-bank term loans and lines of credit to equipment financing, personal loans, and even this thing called credit card stacking. Have you heard of that?
Credit card stack?
Yeah.
I haven't, but I'm intrigued.
Okay.
Okay, so let's start with those non-bank term loans. They sound kind of familiar, like something you'd hear in a bank's brochure.
Yeah. They are structured similarly to bank loans, but here's the twist. Instead of going through a traditional bank, you're actually borrowing from different companies.
Okay, so what kind of companies are we talking about?
We're talking about online lenders, credit unions, peer-to-peer lending platforms, or even companies that specialize in loans just for certain industries.
Ah, so that's where the think outside the bank part comes in.
Exactly.
Makes sense.
Yeah, and the beauty of it is that these lenders are often way more flexible than banks when it comes to credit scores.
Okay.
They're really looking at the bigger picture, your business performance, cash flow, revenue profitability.
Right. They want to see that you can handle the repayments, even if your credit history isn't perfect.
Exactly.
I bet a lot of entrepreneurs listening right now are like, yes, finally.
Yeah.
Okay. But let's get down to the brass tacks.
Sure.
What are the real advantages of going this route, besides the more flexible credit requirements, of course?
Well, I would say speed and accessibility are huge.
Right.
The application process is typically way faster than dealing with a bank, and you can often get the money in your hands much quicker. We're talking days instead of weeks or even months.
Time is money, as they say.
Exactly.
Okay, so is there anything else?
Yeah, I think flexibility in terms is another big. Plus, non-bank lenders might be more willing to customize repayment plans to fit your, specific needs and circumstances. They understand that, businesses come in all shapes and sizes.
Okay, this is definitely sounding like a good option, for those who might not fit the traditional bank loan mold. But what they say, so if it sounds too good to be true.
You're right. There are potential downsides to consider.
Okay.
The trade-off for that easier access and flexibility is usually a higher interest rate.
Okay.
And you might encounter more fees compared to a bank loan. It's crucial to weigh those costs carefully.
So do your homework.
Yes.
Now, what about regulation? Are these lenders subject to the same rules and oversight as traditional banks?
That's a great question, and the answer is not always.
Okay.
Non-bank lenders aren't as heavily regulated, which can be a double-edged sword.
How so?
Well, on the one hand, it allows them to be more agile and responsive to borrowers' needs. But on the other hand, it could mean fewer consumer protections.
So choose wisely.
Yes.
Do your research and make sure you're comfortable with the lender and the terms before you sign anything.
Absolutely.
Okay, now you mentioned something called non-bank business lines of credit earlier. What are those all about?
Okay, so think of it as like a financial lifeline,
Okay.
especially for covering those unexpected expenses that always seem to pop up, managing half flow gaps or seizing a sudden opportunity. It's basically a preset amount of money that you can borrow from Repay and then borrow from again as needed.
So like a financial safety net that's always there.
Exactly.
I like that.
Yeah, and the qualification criteria are pretty similar to those non-bank term loans we just talked about. Lenders want to see a strong track record of business performance, decent credit history, some time in business to show, stability and sufficient annual revenue to handle the credit line responsibly.
So once again, it sounds like they're looking at the overall health of your business, not just fixating on a credit score.
Exactly.
Okay, so what are the advantages that really set these lines of credit apart?
Well, accessibility and speed. for starters.
Okay.
Just like with the term loans, getting approved is often easier and faster compared to going through the bank.
Okay, I'm sensing a theme here.
Yeah, and the flexibility is a major draw. You only borrow what you need when you need it, which can be a real game changer for managing cash flow. Plus, with so many lenders out there, you can shop around and find one that, aligns with your specific business needs.
I love having options.
Yeah.
But, I'm also wondering about those potential drawbacks. What are some things that listeners should keep in mind?
Well, just like with the term loans, you should expect higher interest rates and fees compared to bank lines of credit. You might also run into some extra costs like origination fees or prepayment penalties.
Oh,
And it's important to remember that the repayment terms might not be as flexible as you'd hoped.
so it's all about, reading the fine print and making sure you understand those terms and conditions before you commit.
Absolutely.
Okay, now let's shift gears a bit and talk about equipment. I know a lot of entrepreneurs need specialized machinery or technology to get their businesses up and running.
Right.
What are the options for, financing those big-ticket items?
Okay, great question. Our guide covers two main avenues:
Okay.
equipment loans and equipment leasing. So let's start with equipment loans. Imagine you need to purchase a really pricey piece of equipment, but shelling out all the cash up front would drain your resources. An equipment loan can help bridge that gap.
Okay, so you're basically borrowing money to buy the equipment, and then you
Right.
pay it back over time, just like a traditional loan.
Exactly, and this can be a smart move for businesses that are expanding and need new equipment. Upgrading to more efficient machinery or replacing essential equipment that's broken down or become, obsolete.
So it's not just for brand new businesses.
Right.
Established companies can benefit from these loans too.
Absolutely.
What do you need to qualify for an equipment loan?
Well, a good credit score is always a plus,
Sure.
but it's not the only factor. Lenders also want to see a solid business history. They want to know that you're established and have a track record of success.
Makes sense. What else?
Healthy finances are a must. They'll want to scrutinize your financial statements to ensure you can handle those loan repayments.
Right.
And depending on the lender, you might need to make a down payment of 10 to 20% of the equipment cost.
All right, so there are some upfront costs involved, but let's talk about the advantages.
Sure.
What are the pros of going with an equipment loan?
Well, once you've paid off the loan, you own the equipment outright.
Okay.
It's all yours, no strings attached. And that can be a huge advantage, especially if you're in an industry where owning your equipment gives you a competitive edge.
There's something satisfying about that, knowing you own, the tools of your trade. What else?
There can also be some tax benefits. You might be able to deduct the interest payments and depreciate the equipment over time, which can lower your overall tax burden.
Tax benefits are always welcome. And of course, you get to use that equipment right away, which can be, essential for keeping your business operations running smoothly or scaling up quickly.
Right.
Now, what about the flip side? What are the potential drawbacks of equipment loans?
Well, one thing to consider is that equipment depreciates over time, so you might end up owing more on the loan than the equipment is actually worth, especially if you're in an industry where technology advances really rapidly.
Right.
It's essential to factor depreciation into your calculations.
That's a really important point. Anything else?
Yeah, those upfront costs, like the down payment and any fees, can be a barrier for some businesses.
Right.
And keep in mind that taking on any type of debt affects your ability to secure financing in the future. Lenders will look at your overall debt load when they're evaluating new loan applications.
So it's all about striking a balance.
Exactly.
Now, you mentioned equipment leasing earlier.
Yeah.
What's the deal with that? When does leasing make more sense than buying?
Leasing can be a brilliant strategy if you're in an industry where technology evolves at lightning speed.
Okay.
It allows you to always have the latest and greatest equipment without the long-term commitment of buying it outright. You're essentially renting the equipment for a set period.
Okay, so I can see how that would be appealing for businesses that need to stay on the cutting edge.
Right.
What other scenarios are well suited for leasing?
Short-term projects.
Okay.
Let's say you need a specialized piece of equipment just for a specific project, but you don't need to own it long-term.
Right.
Leasing can be a really cost-effective solution.
Yeah.
You get to use the equipment for the duration of the project without worrying about what to do with it afterwards.
Smart. Any other reasons to consider leasing?
Yeah, preserving your capital. Leasing can free up cash flow that you might need for other areas of your business, like marketing inventory or hiring. It's all about allocating your resources strategically.
Okay, I'm getting a better sense of when leasing might be the smarter move. What about qualifications? What do you need to have in place to lease equipment?
Generally speaking, the qualifications for leasing are less stringent than for equipment loans.
Okay.
Good credit is still helpful, but leasing companies tend to be more flexible even with startups or businesses with limited credit history.
That's good news for entrepreneurs who are just starting out.
Yes.
What else are leasing companies looking for?
They're primarily concerned with your cash flow. They want to make sure you can comfortably cover those lease payments, so they'll be reviewing your financial statements and projections to assess your ability to meet your obligations.
So it's all about demonstrating that you can handle the financial responsibility of leasing.
Exactly.
Now let's talk about the perks. What are the advantages of leasing equipment?
Okay, well, lower upfront costs. You typically don't need a hefty down payment like you would with an equipment loan,
Right.
which means you get to keep more cash on hand for other business needs.
Cash flow is king, especially in the early stages of a business. Anything else?
Yeah, lease contracts can be quite flexible with terms tailored to your specific needs.
Okay.
You might be able to negotiate the lease duration payment schedule or even upgrade options.
That flexibility can be a real game changer. What about tax benefits?
In many cases, you can deduct your lease payments as a business expense, which can reduce your overall tax liability.
Okay.
It's always a good idea to consult with a tax professional to understand the specific tax implications of leasing in your jurisdiction.
Solid advice. Now, for the big question, what are the downsides of leasing? What should listeners be wary of?
Well, the main drawback is that you don't own the equipment at the end of the lease term.
So it's like renting a car.
Yeah,
You're paying for the use of the equipment, but it's not yours to keep
right.
unless you have a buyout option.
Precisely. There's often a buyout option at the end of the lease, allowing you to purchase the equipment at a predetermined price, but that will add to your overall costs.
Got it. What other potential downsides should listeners consider?
Leasing can actually be more expensive than buying over the long term, especially if you end up leasing the same equipment for an extended period.
Okay, so it's crucial to run the numbers and compare the total cost of leasing versus buying anything else.
Yeah, those lease contracts can be tricky to break or change.
Right.
Make sure you thoroughly understand the terms and conditions before you sign anything. Pay close attention to any penalties for early termination or modifications to the agreement.
Always read the fine print, right?
Yes.
Now, I want to talk about a financing option that some listeners might find a bit surprising.
Okay.
Using personal loans for business purposes. Is that even allowed?
Absolutely. It's a legitimate strategy, and it can be a viable option in certain circumstances.
Okay, so walk me through this. How does it work?
Instead of applying for a business loan, which is based on your business's creditworthiness, you're actually leveraging your personal credit history to secure a loan.
Okay.
Then you can use those funds for your business.
Interesting. So it's like you're personally vouching for the loan, even though it's for your business. What kind of situations make the most sense for using a personal loan to fund your business?
Well, it can be a lifeline for covering startup costs before you have any business revenue coming in.
Okay.
You know, new businesses often struggle to qualify for traditional loans because they lack a proven track record.
So a personal loan can be that initial boost to get things moving.
Exactly.
What other scenarios might warrant using a personal loan?
They can be helpful for smaller scale expansions or equipment purchases.
Okay.
Maybe you need to invest in some new tools or technology, but you don't need a huge sum of money.
Right.
A personal loan could be a good fit.
What about situations where you need cash quickly, like to cover an unexpected expense or seize a time-sensitive opportunity?
Exactly. Personal loans can provide a quick cash injection for those short-term needs, bridging the gap until your business revenue catches up.
Okay, so I'm seeing the appeal, but let's talk about qualifications. What do you need to have in place to be eligible for a personal loan? And what are lenders looking for when they're reviewing your application?
Well, your personal credit score is the most critical factor here.
Okay.
Lenders typically want to see a score of at least 690 or higher. The better your credit score, the better your chances of approval, and the more favorable the interest rates you'll be offered.
So maintaining a good credit score is crucial, even if you're primarily focused on building a business.
Absolutely.
What else are lenders looking at?
They want to see stability.
Okay.
A steady job and a consistent income history demonstrate that you have the means to repay the loan, so they'll be reviewing your employment history, income verification documents, and bank statements to assess your financial stability.
Makes sense. They want to make sure you're not taking on more debt than you can handle.
Exactly. And they'll be looking at your debt-to-income ratio, which is a measure of how much debt you have compared to your income. A low debt-to-income ratio shows lenders that you're managing your debt responsibly and have room in your budget for those additional loan payments.
So it's a holistic view of your financial situation.
Yes.
Now let's talk about the pros. What are the advantages of using a personal loan for business purposes?
Okay, well, the biggest pro is flexibility.
Okay.
You can use the money however you see fit for your business. There are no restrictions on how you can spend the funds.
I love that freedom. No need to justify your expenses or jump through hoops to get approval for specific purchases. What else?
Speed.
Okay.
Personal loans often have a faster approval process than business loans. You could have the money you need in your bank account within a few days.
I bet.
Yeah.
And what about for new entrepreneurs who are just starting out and haven't had time to build up a business credit history yet?
That's where personal loans can really shine.
Oh,
You can leverage your personal credit history to get your business off the ground. It's a way to bootstrap your way to success without having to rely on traditional lending institutions that might be hesitant to work with startups.
all right. So there are definite advantages to using personal loans for business. But as we've learned with all of these financing options, there's always a flip side. What are the potential downsides?
Well, the biggest risk is that if your business fails, your personal credit takes a direct hit.
Okay.
You're essentially putting your personal finances on the line to support your business venture.
That's a sobering thought.
It's essential to go into this with your eyes wide open.
Right.
You're blending your personal and business finances, so if one goes south, the other could be impacted.
Any other potential downsides to consider?
Yeah, personal loan amounts are generally smaller than business loan amounts.
Okay.
So if you need a substantial sum of money, a personal loan might not be sufficient.
So it's not the ideal solution for major expansions or large-scale investments.
Right. And depending on your personal credit score, the interest rates on personal loans can be higher than the rates you might qualify for on a business loan. So it's crucial to compare rates from multiple lenders and make sure you're getting the most favorable terms possible.
So shop around and don't be afraid to negotiate.
Exactly.
Now, I want to talk about a strategy that sounds like something out of a financial thriller.
Okay.
Credit card stacking.
Yeah.
What is this all about? Is this even a real thing?
It's a real thing, and it can be a powerful tool, but it's not for the faint of heart.
Okay.
It involves applying for multiple credit cards simultaneously.
Hold on. Why would anyone do that?
The goal is to combine the credit limits from those multiple cards to create a larger pool of available credit that you can then use for your business. It's a way to amplify your purchasing power and access more capital quickly.
Okay. I'm starting to do the logic here.
There are even third-party companies that specialize in helping businesses with this process. They'll assist you in applying for multiple cards at once, strategizing to maximize your chances of approval and secure the highest possible credit limits.
So it's like having a financial coach in your corner,
Yeah.
guiding you through the process. What are the potential benefits of credit card stacking?
Well, speed and accessibility.
Okay.
It can be a way to get your hands on a substantial amount of cash quickly, especially if other financing options are limited or you've been turned down by traditional lenders.
So for businesses that need funding ASAP or have less than perfect credit, this could be a lifeline.
Exactly. Flexibility.
Okay.
You have the freedom to use those funds for anything your business needs, whether it's inventory, equipment, marketing, or covering payroll. You have the autonomy to allocate those funds as you see fit.
I can see how that would be empowering for entrepreneurs who want to be in control of their finances. And what about rewards? I know a lot of credit cards offer perks like cashback travel points or discounts.
Absolutely. Credit card rewards can be a valuable bonus, especially for businesses that spend a significant amount of money each month. You can rack up some serious rewards points that can offset your expenses or even be used for personal travel or leisure.
Okay, so credit card stacking sounds like it has the potential to be a powerful financial tool. But I know there must be risks involved. What are the downsides?
The biggest red flag is the high interest rates that come with credit cards.
Okay.
If you're not extremely careful and disciplined about managing your debt, things can spiral out of control very quickly.
Yeah, I can see how that could happen. Multiple cards, multiple interest rates, multiple due dates. It sounds like a recipe for financial overwhelm.
It's crucial to have a solid plan in place for managing those multiple cards and making timely payments.
Okay.
And applying for multiple cards in a short period can actually damage your credit score.
Wait, really? That seems counterintuitive. Wouldn't having access to more credit make you look more creditworthy?
Not necessarily. The credit scoring algorithms view multiple credit applications in a short period as a red flag. It makes you appear risky to lenders as if you're desperate for credit.
So it's a delicate balancing act.
Yeah.
What other downsides should listeners be aware of?
Well, juggling multiple cards can be a logistical nightmare, especially for busy entrepreneurs.
Right.
Keeping track of different due dates, minimum payments, interest rates, and reward programs can be overwhelming. And let's not forget the biggest danger of all overspending.
Yeah.
It's easy to get carried away when you have access to a lot of credit, leading to a mountain of debt that's difficult to climb out of.
So credit card stacking is not for the faint of heart.
Definitely not.
It's a high-risk, high-reward strategy that requires a disciplined approach and a solid understanding of personal finance principles. Who would you say are the ideal candidates for this strategy?
Startups with limited business credit history might consider this option if they've exhausted other avenues and need immediate funding.
Yep.
But it should be approached with extreme caution and a clear plan for managing the debt responsibly.
So a last resort, basically not a first-line strategy.
Right.
What about established businesses?
It might work for businesses with unpredictable expenses that need immediate funds. Maybe you're in an industry with fluctuating demand, or you have a sudden opportunity that requires a quick infusion of cash.
But the key is to be able to repay that debt very quickly to avoid those sky-high interest charges from snowballing.
Exactly. It's a short-term solution, not a long-term financing strategy.
Okay, let's move on to a more traditional, though still very powerful financing option, SBA loans. I know a lot of entrepreneurs dream of securing one of these coveted loans. What makes them so special?
Well, SBA loans are designed specifically for small businesses and are partially guaranteed by the Small Business Administration, or SBA,
What?
which is a government agency that supports small businesses.
So they're not direct loans from the government, but the government is essentially backing them up in some way.
Precisely. SBA loans are issued by private lenders like banks and credit unions, but that SBA guarantee reduces the risk for those lenders.
Okay.
That makes them more likely to approve loans to small businesses that might not meet their usual lending criteria.
So it's like having the government vouch for you,
Yeah.
which can be a huge advantage for startups or businesses with less than perfect credit.
Yep.
What are some of the other benefits of SBA loans? What makes them so appealing to entrepreneurs?
Well, one of the biggest perks is that they typically require smaller down payments compared to conventional loans.
Okay.
This can be a game changer for businesses that are tight on cash or want to preserve their working capital for other expenses.
That's huge, especially in the early stages of a business when every dollar counts. What else?
SBA loans often come with more favorable terms and conditions.
Okay.
You might snag a lower interest rate and a longer repayment period compared to a traditional bank loan, which can ease the burden on your cash flow in the long run.
Lower monthly payments and more time to repay the loan.
Yeah.
That sounds like a win-win.
Oh.
Are there any other advantages?
Because they're backed by the government, SBA loans are generally easier to qualify for, even if your credit history isn't spotless. Startups and businesses that have faced financial challenges in the past might find that an SBA loan is their ticket to getting back on track.
So it's a more inclusive approach to lending, recognizing that businesses go through ups and downs.
Mhm.
Anything else?
One of the most valuable but often overlooked benefits is the free business counseling and training that the SBA provides to borrowers.
Oh, wow.
They offer a wealth of resources and support to help you succeed, which can be invaluable for new or struggling businesses.
Wow, that's a fantastic perk. Access to expert advice and guidance can make all the difference. Now, I know that no financing option is perfect. What are the potential downsides of SBA loans?
Well, the biggest complaint you'll hear is about the paperwork.
Oh, yeah.
Be prepared for a lot of it. The application process can be quite lengthy and involved.
Government bureaucracy, right? It's almost inevitable.
And that means the processing time can be quite slow, so if you need funding quickly, an SBA loan might not be the best option.
So it's not for those last-minute emergencies or time-sensitive opportunities. Got it. What else?
There can be restrictions on what you can use the funds for.
Okay.
The SBA has guidelines on how the loan money can be spent, and you might need to get approval for certain expenditures.
So it's not as flexible as some of the other financing options we've discussed. What about prepayment penalties?
Some SBA loans do have prepayment penalties, so
Yeah.
if you pay off the loan early, you might get hit with extra charges.
Oh.
It's essential to read the loan agreement carefully and understand all of the terms and conditions before you commit.
Always a good idea to get clarity up front.
Yeah.
Anything else?
You might still need to provide collateral to secure the loan.
Right.
Depending on the specific program and the lender's requirements, this could be real estate equipment inventory or other assets that the lender can seize if you default on the loan.
So there's still an element of risk involved, even with the government backing. Now I'm curious about how SBA loans stack up against traditional bank loans. What are the key differences?
Well, as we've discussed, SBA loans are generally easier to qualify for, and they often come with lower interest rates and longer repayment terms. This can make them a more attractive option for borrowers who might not meet the strict lending criteria of traditional banks.
So they're more accessible and often more affordable in the long run. Anything else?
You might also be able to borrow a larger amount of money through an SBA loan compared to a bank loan.
Right.
The SBA has different loan programs with varying maximum loan amounts, allowing you to secure the funding you need to grow your business.
So it's worth exploring the different SBA loan programs to see which one aligns with your financial needs. Anything else?
And of course, you get that extra support from the SBA with their counseling and training programs.
Right.
This can be invaluable for small business owners who need guidance on managing their finances, marketing their products or services, or navigating the challenges of entrepreneurship.
Okay, so SBA loans are definitely worth considering for entrepreneurs who are looking for accessible, affordable, and supportive financing options.
Absolutely.
Now let's talk about our final finance,
Okay.
inventory financing.
All right.
What is this all about and how does it work?
Okay, so imagine you're drowning in customer orders, but you don't have enough product to sell.
I've been there.
Inventory financing can come to your rescue.
Okay, that's a scenario I think a lot of entrepreneurs can relate to.
Yeah.
You've got the demand, but you need capital to fulfill those orders.
Exactly. Inventory financing involves using your inventory as collateral for a loan or line of credit.
Yeah.
You're essentially leveraging the value of your products to secure funding.
So if you have a warehouse full of in-demand products, you can use that inventory to access capital. That's pretty clever. What are the advantages of inventory financing?
Well, it can be a fantastic way to free up cash flow.
Okay.
Instead of tying up all of your capital in inventory, you can use that inventory to secure funding that you can then use to pay other expenses or invest in other areas of your business.
That sounds like a smart way to maximize your financial resources. What else?
Inventory financing allows you to buy more inventory to meet that surging demand or prepare for business growth. If you're confident in your sales projections and have a reliable supply chain, inventory financing can help you scale up your operations without being held back by limited capital.
So you can capitalize on opportunities without having to dip into your savings or delay expansion plans. What about the repayment structure? How does that work with inventory financing?
One of the unique features of inventory financing is that the repayment terms are often tied to when you sell the inventory.
Okay.
So you're not stuck with fixed monthly payments that could strain your cash flow if sales are slow.
That's a huge advantage.
Yeah.
It aligns your debt repayments with your revenue stream, making it easier to manage your finances.
Okay, I'm liking this so far, but as always, I know there are potential downsides to consider.
Right.
What are the cons of inventory financing? What should listeners be wary of?
Well, the biggest risk is overbuying inventory that you can't sell.
Okay.
If you're overly optimistic about your sales projections or if the market shifts unexpectedly, you could end up with a warehouse full of products that aren't moving, and that's a recipe for a cash flow nightmare. So it's essential to be realistic about your sales forecasts and to have a contingency plan in case sales don't meet your expectations.
Absolutely. And if your inventory doesn't move as quickly as you anticipated, repaying the loan can become a major challenge.
Okay.
You could end up owing more money than your inventory is worth, putting your business in a precarious financial position.
That makes sense. Anything else?
Inventory financing can be quite expensive, often more so than other types of business financing.
Right.
You'll likely face higher interest rates and fees compared to traditional loans or lines of credit.
So it's crucial to factor those costs into your calculations and make sure that the potential benefits outweigh the financial risks. Now, what do lenders look for when evaluating applications for inventory financing? What are the key requirements for approval?
Well, they want to see a track record of success.
Okay.
Strong business financials, including a healthy sales history and solid financial statements, are essential. Lenders want to see evidence that your business is viable and profitable.
So it's not just about the inventory itself.
Right.
It's about the overall financial health of your business.
Exactly. And a good credit score is still crucial.
Sure.
It demonstrates that you're a reliable borrower who pays your debts on time. Lenders will review your credit history to assess your credit worthiness.
Makes sense. What else?
The quality and saleability of your inventory are key.
Okay.
Lenders want to know that your inventory is valuable and can be easily sold if needed. No dusty old stock allowed.
Got it. So make sure you have desirable products that are in demand and have a reasonable turnover rate.
Exactly. And you'll need to have meticulous inventory records.
Right.
Lenders will want a clear picture of your inventory levels, turnover rates, and historical sales data. They need to be confident that you're managing your inventory effectively and have a system in place for tracking and valuing your products.
So stay organized and keep those records up to date.
Absolutely. And finally, you'll need a solid business plan and accurate sales forecasts. You need to convince the lender that you have a plan to manage and sell that inventory effectively. They'll be looking for realistic projections that demonstrate a clear path to profitability.
Great advice. It sounds like preparation is key when applying for inventory financing. Now, before we wrap up this part of our deep dive, I want to remind our listeners that they can get a free copy of our guide, Think Outside the Bank, 10 Innovative Solutions for Financing Small Businesses, by visiting thinkoutsidethebank.info.
That's right. We've packed it with all the details on these financing options and more.
So go ahead and grab your copy. It's a valuable resource for any entrepreneur who's looking to explore alternative financing options and unlock the capital they need to grow their business.
Absolutely.
We'll be back in a moment to continue our exploration of these exciting financing options.
Sounds good. Welcome back, everyone. So I hope you're feeling as pumped as I am, knowing there's so many options out there, beyond those traditional bank loans. Yeah, for real. It's like a whole new world has opened up, especially for entrepreneurs who don't exactly fit, what banks typically look for.
Exactly. And remember, we've only just scratched the surface here.
Right.
There's so much more to discover in our guide. Think outside the bank.
Yes.
But before we jump back into all those financing strategies,
Okay.
let's just take a second and recap what we've learned so far.
Okay, great idea. It's easy to get caught up in all the details, so a little recap will definitely help solidify those key takeaways.
Right. So we started with non-bank term loans.
Yes.
Which offer a more accessible and faster alternative to traditional bank loans,
Yeah.
often with more flexible credit requirements.
Right, but we also learned that those perks often come with a price tag, right?
Yeah.
Higher interest rates and potentially more fees.
Exactly. And we can't forget about the importance of, carefully vetting those non-bank lenders.
Yeah. Less regulation can sometimes mean fewer consumer protections. So it's super important to do your homework and choose a reputable lender with, transparent terms and conditions.
Solid advice.
Yeah.
Then we moved on to non-bank business lines of credit,
Yes.
which are like a financial safety net, for covering those unexpected expenses or bridging those cash flow gaps that every business, faces at some point.
Right. And just like with non-bank term loans, those lines of credit offer faster approval times and more flexible terms than you might find at a traditional bank.
Right. But again, be prepared for those higher interest rates
Yeah.
and possibly some additional fees.
Exactly.
It's all about weighing those pros and cons and making sure the benefits outweigh the costs
Right.
for your specific situation.
Exactly.
Okay, then we talk about all those big ticket purchases.
Yeah.
Specifically equipment financing with those two main options, equipment loans and equipment leasing.
Yes. Equipment loans are a great way to gain ownership of, essential equipment without having to shell out a ton of cash up front.
Right.
But those loans often come with, those hefty down payment requirements
Yeah.
and potential for depreciation to kind of work against you, especially in industries with rapidly evolving technology.
Depreciation is definitely a sneaky one.
It is.
Good to keep in mind. Then we explored equipment leasing, which is kind of like that rent-to-own model
Right.
for business equipment.
Exactly.
And it offers those lower upfront costs and the flexibility to upgrade to newer models more easily.
But as we learned, leasing can sometimes be more expensive over the long term.
Right.
And those contracts can be tricky to break or change.
Yeah.
So it's crucial to understand the fine print and make sure that leasing aligns with your, long-term business goals.
Then we took a detour into the world of personal finances
Yes.
and explored that sometimes controversial strategy of using personal loans for business purposes.
Yeah, it can be a viable option for startups or those who need funding quickly.
Yeah.
But it's essential to weigh the risks carefully.
Right. If your business fails, your personal credit takes a hit.
Exactly. It's like you're putting your personal finances on the line
Yeah.
to support your entrepreneurial dreams.
So it's not a decision to be taken lightly.
No.
And then there was credit card stacking,
Oh, yes.
that high-stakes strategy for amplifying your purchasing power by strategically applying for multiple credit cards.
Right. It's a powerful tool for those who can manage it effectively,
Yeah.
but it's definitely not for everyone.
Right.
Those high interest rates can quickly turn into a financial avalanche if you're not careful.
For sure.
Disciplined budgeting and a solid understanding of personal finance are absolute musts
Yes.
for anyone considering this strategy.
So finally, we explored those SBA loans. The gold standard of small business financing.
Yeah.
They're accessible, often more affordable than bank loans, and come with that added bonus of free business counseling and training from the SBA.
But those perks do come with a price, paperwork processing time and potential restrictions on how you can actually use the funds.
Yeah. It's all about finding that sweet spot,
Right.
the financing option that aligns best with, your business needs, your financial situation, and your risk tolerance.
Exactly.
So with that recap in mind, let's jump back into our exploration of these innovative financing solutions.
Okay.
We left off talking about inventory financing, which is perfect for businesses that need capital to, stock up on product to meet that growing demand.
Right.
We talked about the advantages of inventory financing, like freeing up cash flow and allowing you to scale up your operations more quickly.
Right.
But we also touched on the potential risks, like the danger of overbuying inventory
Yeah.
and finding yourself in a cash flow crunch if sales don't meet those projections.
Yeah.
And we can't forget about those potentially higher interest rates and fees.
For sure. So it's all about finding that sweet spot where the potential rewards outweigh the risks.
Right. And that's where due diligence comes in.
Exactly. Lenders want to see a track record of success. So strong business financials are key. They'll be looking at your, sales history, your profit margins, your cash flow projections.
Right.
They want to be confident that you have a viable business model and a solid plan for managing your inventory.
And of course, a good credit score is always a plus.
Oh, yeah.
It shows lenders that you're a responsible borrower
Right.
and that you pay your debts on time.
Exactly.
It's not just about the inventory itself. It's about your overall financial health and creditworthiness.
Absolutely. And lenders want to see that you have, valuable, easily sellable inventory.
Right.
No dusty old stock just sitting in the back of your warehouse.
Got it. Quality over quantity
Exactly.
when it comes to inventory financing. Now, what about inventory management systems? Do lenders care about that?
Oh, they definitely do.
Okay.
Lenders want to see that you have, meticulous inventory records
Yeah.
and a reliable system for tracking and valuing your products.
Right.
They need to be confident that, what you have, where it is, and how much it's worth.
So invest in a good inventory management system.
Yeah.
If you don't already have one.
Absolutely.
It's not just good business practice.
Yeah.
It can actually make you more attractive to lenders.
For sure. And finally, lenders will want to see a, well thought out business plan and accurate sales forecasts.
Okay.
They need to be convinced that you have a plan to manage and sell that inventory effectively.
Right.
They'll be looking for, realistic projections that demonstrate a clear path to profitability.
So do your research, crunch those numbers, and
Yep.
and make sure your projections are realistic
Yes.
and backed by, solid market data.
Absolutely.
Now, before we move on to our final thoughts,
Okay.
I want to remind our listeners that they can get all of this information and more in our comprehensive guide, Think Outside the Bank, 10 Innovative Solutions for Financing Small Businesses.
Yes, it's a free resource packed with, actionable insights and tips to help you navigate the world of alternative financing and secure the capital you need to grow your business.
Just visit thinkoutsidethebank.info and download your copy today.
Now, as we wrap up our deep dive into the world of alternative financing, we want to leave you with a thought-provoking question to ponder. With all of these incredible financing options available, what kind of business could you start or grow? What dream could you bring to life if you had access to the right kind of funding?
That's a great question.
Yeah.
It really shifts that perspective,
Right.
from can I even get the funding
Right.
to what could I do if I had the funding?
Exactly. And that's what we want our listeners to take away from this deep dive.
Right.
A sense of possibility, a sense of empowerment.
You don't have to let, limited access to traditional financing hold you back.
Right.
There are options out there. You just need to know where to look
Yeah.
and how to navigate the process.
Exactly. And that's where our free guide, Think Outside the Bank, comes in.
Yes.
It's your roadmap to exploring those alternative financing options
Yeah.
and finding the perfect fit for your business.
So don't wait. Head over to thinkoutsidethebank.info right now and download your free copy. It's packed with, valuable insights, tips, and resources.
Absolutely.
To help you secure that funding, you need to make those entrepreneurial dreams a reality.
We're so excited to see what you create and achieve.
That's it for today's deep dive into the world of alternative financing solutions. Thanks for joining us.
Remember, think outside the bank.
Yeah.
There's a whole world of funding possibilities waiting to be explored.
Until next time, keep learning, keep growing, and keep diving deep.